Also joining us now live from the CME in Chicago, Larry Shover, Chief Investment Officer at SFG Alternatives, just to give us some more insights into everything going on in the US. And of course there is a lot. Obviously the fiscal cliff is what everyone's talking about. What do you think after hearing Ben Bernanke speak there, this continued warning about the issues, the damage that could be done if a deal isn't sorted out? Do you think that those congressmen will listen to that and take note that there will be something sorted out before Christmas?
Yeah, I think the way it looks right now, the market's very binary. It's all yes or no. And right now it seems like the answer is going to be yes, that something will get struck at least by the end of the year. It might not be what everybody wants, but I think the payroll tax cuts will lapse. There will be some rate hikes for the ultra-wealthy people. There will be a down payment probably for the deficit, but it just will buy them more time to figure this out. But I do think some type of deal will be struck by the end of December.
Just looking, I guess, at the Fed and some of those comments through from Ben Bernanke, what did you make of that? I mean, he kind of talked about the fact that, obviously there is this discussion on setting actual targets in terms of unemployment and inflation for the point at which the Fed would start to return to normalised policy. What do you think of that? I mean, saying that, look, it's a very promising step to try and develop that, but it's all still under discussion. Do you think that the Fed would perhaps introduce that sort of statement targets?
Well, I believe the market's telling us that that's just unreasonable to expect. I mean, no one's brave enough right now to say when's policy going to reverse, and I think the last QE really isn't doing a whole lot to the economy, and now that he's adding language to it, it's all very well and good. But I don't think the market's embracing it the way most of us would hope the market would embrace it, because it is, I mean, we have a lot of things ahead of us that we have to deal with. Just imagine in the U.S. in the next 10 years, if we don't deal with Social Security, Medicare, Medicaid, even if we don't touch those expenditures whatsoever, we're going to have to raise 4 times more revenue than we're trying to raise right now in the next 10 years. And that's just unthinkable right now. So I think the market's just trying to sift it all out and figure out where we're going to go short term.
I guess the other issue, I mean, could you see the Fed upping its asset purchase volumes? Would that be another option?
I think it's another option, but I do think that's an outlier. I mean, I think it's going to be one of those things where language from the Fed's going to rule the day, and they're just going to keep rates as low as possible, as long as possible, until we see the stubborn unemployment rate pick up and also business capital spending pick up. And they're the two headwinds that we're facing right now.
What did you make of the housing data? I mean, more strong data seen overnight, tipping that the housing recovery is really gaining traction there. Is that, are you a believer?
I'm definitely a believer, because we did fall down, we fell off a cliff, a 5-year flight of steps, as it were, in terms of housing. And perhaps it was overdone just a little bit. Do I think we're going to go back to pre-2007 levels? Not now, not in 10 years, not in 20 years probably. However, there is stabilization. I think the market is underappreciating the tailwind that housing market can lend to building, to the financial markets, to mortgage origination and everything. So it's going to be a tailwind.
I just want to get our guest host Gavin Stacey from Barclays' views on this too, the housing figures we've been getting through. Housing starts at their highest rate in more than 4 years in October. I mean, the expectations had been for a slowdown. What do you make of what we're seeing in the US housing market?
Yeah, it's certainly one of the bright spots on the US economic front, because what it's showing is that finally that deleveraging in the household sector from those excesses clearly every English-speaking country had going into the global financial crisis. Those excesses have been dealt with to some degree, and now we're starting to see the household nibbling away at those bargains that exist in the US housing market. Now, of course, the banks are a lot more prudent now in terms of who they lend to. Before the global financial crisis, they'd lend to anyone. You didn't even need documentation, just here's the money, go spend it. Now the banks are a lot more tight in terms of who they lend to, but for those with decent credit ratings, decent incomes, they're now seeing low interest rates, and they're slowly but surely coming back into the market.
Just turning to Europe, if we could, Larry, and just wanted to get your thoughts on that too. We've got the European finance ministers meeting right now, trying to nut out some kind of a deal on Greece. Do you think we're going to see that? I mean, there's been talk through of some of the things that they're looking at, you know, trying to bring the debt to GDP down to 120% by 2020. You know, talking about a 10-year moratorium on interest payments on the EFSF loans and cutting interest on bilateral loans to Greece to 25 basis points from 150 basis points, something Germany's not happy with from what we're hearing. What do you think of all of this? I mean, is Greece going to just muddle through again and get the bailout funds?
Well, right now they're muddling at, what, 180% debt to GDP ratio. They have an unsustainable amount of debt. And I think the only way that I'm going to become a believer, or when I do become a believer, is when there's substantial debt forgiveness. Because in my view, there's absolutely no other way for Greece to survive. There's going to have to be debt forgiveness.
So you see that those public creditors are going to have to take a haircut, even though certainly that's something that the Bundesbank has not been happy about at all.
Yeah, I mean, unless I'm standing in the wrong line or took the wrong math courses, I mean, I just can't see how they can go from 180% to 120% in that time, given the amount of problems that they have. There has to be a haircut, and a massive haircut, and that's just coming. It's just a matter of when.
Is that something you see having to happen? I mean,
it's sort of inevitable. And as we were discussing earlier, it's all about sort of ring fencing Greece, getting it off the headlines, and then Europe can go about putting in place those structural reforms, fiscally, but also economically, to get the economy up and running again. That's clearly where we're at.
Yeah, Larry, just on, I guess, Spain too. I mean, obviously that's been a big focus for markets, is whether Spain's actually going to ask for a bailout. What do you think? I mean, still weighing up the benefits of whether it needs to do that?
Yeah, I think they are, and I think they're being really careful. I mean, they haven't had this situation probably since 1937 during their failed civil war. So their financing seems to be in place, believe it or not. At least that's what we're hearing. And I do think your point is very, very well said. I think they're waiting to see what they actually need before they come to ask for the rescue.
And this idea that Gavin was mentioning there of trying to ring fence some of those core European economies from the issues of the peripherals. I mean, the issue now, though, is that France, the second biggest economy, is having such troubles, even though the French say, no, we're not. Well, what do you think? I mean, Moody's downgrading now. I mean, that was no surprise, but still, you know, is it the time bomb of Europe?
Yeah, you know, it was absolutely no surprise. It's amazing. You wake up this morning, France gets downgraded, nobody cares. It's amazing to think. But, you know, in the last 6 months, maybe 9 months, they've been a beneficiary of good yields because of people trying to find yield, and France was better than anything else other than Germany trying to find a positive yield. So they have benefited from that. That's probably going to evaporate given their downfall in their credit rating. But ring fencing all sounds well and good, but let's see it be implemented. It's a different story because Germany doesn't like it right now.
What about German growth too? I mean, obviously, is that going to slip as we see these other issues in other major countries?
Yeah, I think it's going to have to, but I think really the country that no one's talking about that I'm most worried about is actually the UK. I mean, they've been spared a lot of this for obvious reasons, but they are not growing right now, and I've slashed their GDP forecast going forward. I think it's going to be really, really hard for them. But back to your point, yeah, Germany is suffering a little bit, and I mean, how can they not, just given what's going on in the southern part of Europe?
And just finally, quickly looking at copper prices, what have you been watching in terms of that? I mean, they're actually just watching your copper now, pretty flat actually, after the big gains in yesterday.
Yeah, I know Australians will love this or maybe get tired of me, but I really am bullish on copper. And I think it's been stuck in like $150 a ton range for a long time. There's definitely negative premium built into the price right now because so many people are concerned. But I do believe there's going to be stabilization, continued stabilization in China. Obviously, copper is going to be a beneficiary of that, along with emerging market Asia, ex-Japan. So I am definitely bullish on copper right here.
All right, Larry, always great to get your insights. Thanks so much.